Today's earnings had software giants bragging about freezing headcount, a legacy design firm creating new billing tiers to charge autonomous bots, and a chip maker handing over $1 billion in upfront cash just to jump the supply chain line.
Right, and it is May 27th. Looking across the batch today, Salesforce, Snowflake, Synopsys, and Marvell. The actual quality of these reports was incredibly messy. There is a lot of paper distortion hiding underneath these AI headlines.
Exactly. So let's start with the most obvious structural shift. Software platforms are basically decoupling growth from hiring humans.
Yeah, they are literally halting it. I mean, Salesforce CEO Mark Benioff made a point to say their 15,000-person engineering base has been completely flat. That is a direct margin strategy.
Which is wild for a high-growth platform, and Snowflake was even more extreme. They hired exactly 17 organic employees globally last quarter, largely because their internal AI code is resolving tickets so much faster.
But there is a catch there. The earnings quality on those software beats was really not clean. Salesforce funded a debt-fueled stock buyback to prop up its earnings.
Right, inflating the per-share optics while organic top-line growth is clearly exhausting. Snowflake also masked a steep drop in their unbilled backlog. So the human leverage is real, but they are absolutely using it to hide demand issues.
Okay, well, if you are a software vendor and your customers stop hiring humans, you have a completely new problem. You cannot sell traditional seat licenses anymore.
No, you have to sell to the bot. And that is exactly what Synopsys is doing. They're shifting their chip design software to add a consumption layer specifically to bill AI agents that are working all day.
Salesforce is doing the exact same thing. They're pushing these flex credits and charging for autonomous work units. Clients are just bypassing the visual interface entirely to plug bots directly into the back end.
Which basically ends the predictable long-term subscription contract. You're moving from guaranteed seats to variable consumption.
It is highly cyclical. It makes them vulnerable to economic shocks in a way they were not before.
Now, while software is turning into this pure automated cash machine, the hardware side of this earnings batch is intensely physically constrained.
Oh, completely. Marvell committed $1 billion in cash prepayments for this year alone. They literally have to wire cash to foundries just to lock down factory space.
Handing over $1 billion just to wait in line?
More or less. And their report was hilarious on paper because their net income crashed purely from past merger liabilities. But the underlying cash generation from data center demand is incredibly strong. The headline GAAP numbers are functionally useless right now.
So the real watch point from this window is consumption risk. If these giants transition fully to variable bot billing, any economic pullback could instantly wipe out that revenue flow.
Software loses its safety net, and hardware just keeps paying the physical toll.
The individual company episodes break down exactly how these giants are restructuring their business models underneath all this noise. Talk to you tomorrow.